Hey, good afternoon guys, my name is TJ and welcome back to my channel. So today I'm gonna have a very special guest with us to talk a bit more about the stock market, and I personally as a real estate agent here in Singapore, I'm gonna talk more about the real estate market. So I think this is pretty much quite a rare occasion where someone from the stock market expertise will be joining forces to talk about the local Singapore real estate market as well. So this person that I'm going to introduce, he's going to be a highly recognizable face to many of you out there, I would say. And personally to me, I think I would call you my matchmaker as well, because without him I wouldn't have met my wife to date. But those of you out there, you will know him as an author, an entrepreneur, an investor, an educator. So we have none other than Mr. Adam Khoo here with us.
Hello.
Yeah.
Yep, great to be here.
Okay.
Couldn't say no to you.
From 18 years into making this video.
18 years, yeah.
So I think
Can't say no to old friends.
I think a bit of background between myself and Adam is I actually met Adam in year 2006. So that was where I attended your I Am Gifted, So Are You, the youth program, right? Do you remember anything about me back then?
Yeah. You were someone who didn't want to study, you were very rebellious, and your mom sent you and said, can you help my son to make sure that he studies?
Okay, but today not like that anymore. Today improved already, ever since 2006. Okay, but really very grateful to you as well for the system, the program back then. I think I actually brought a little something from 2006. You actually wrote me a little note. I don't think you remember, you wrote a lot of people.
I wrote a lot of notes.
Yeah. Okay, so I think this note I actually kept you today as a reminder. This is your handwriting.
Wow. Okay, yeah, that's my handwriting, correct.
Yeah. So this note, I think back then as a 16-year-old teenager, it really created an impact to me, and those principles that you taught during the program, it really brought me a long way, because I always say this, without that program, without you, without this letter, probably I won't be here today with the little success that I have. Right, so thank you for that, Adam.
I really appreciate that. Yeah.
Okay, so moving forward, why I decided to invite Adam to come on my channel to talk about today's topic. I think really after coming out into the workforce as well, I think financial freedom is what most of the people are talking about in Singapore. But of course, it's a very wide definition, and even though we kind of stopped contact. I stopped coaching back with your company as well, but I still follow your YouTube channel very, very frequently. In fact, every week, okay, me and my wife will look at your YouTube channel to see, okay, what are we gonna be looking for in terms of the stocks, what markets are good to look at. And I would like to say that through that, I actually built my stock market portfolio faster, which accelerated me to make my first property purchase even sooner than what I intended to in 2021. And fast forward, after I depleted my stock account, then I put the money back into the stock market again, and it enabled me to buy my second property just last year in 2023, just 2 years apart of each other. So I think stock market and real estate market, it kind of comes hand in hand. Right, because a lot of people, you put money every month into the stock market. Okay, essentially you build 6-7 figures. Right, essentially this money got to be used for something, which I believe in Singapore, because we have good leverage, good systems in place. The property market is a very safe place for us to put our money back into. Right, so this is the premise why we are doing this video, to share more about investing in the stock market and real estate market over here. Okay, so maybe I'll ask you the first question.
Sure.
Adam, right? So we are going to talk a bit about four to five topics today. Okay, so the first topic, question to you. I think a lot of my friends knew that I'm doing a video. They wanted to find out as well. What are some of the principles of investing in the stock market that you have to share with our audience?
I think before investing in anything, you have to understand what you're buying. So before you go into the stock market, you got to ask yourself, when you buy a share of stock, what are you buying? And I can tell you that most people don't know. When they think of a stock as some number or some alphabet that goes up and down, and you got to predict, will it go up next day, next month, next week? They hope it don't go down, right? No, if you buy a share of stock, you're buying a piece of a business, right? When you buy a share of stock, you're becoming the part owner of a business. And I think that's the first thing to understand, because if you focus on businesses that make more money every year, consistently, through good times and bad times, that means the business will be worth more and more. And the share price would, over time, trade higher. So that's the first principle. You have to know what is a stock. A stock is a business. And what is a stock market? Okay. A lot of people, they treat the stock market as a casino, which you can. right? Where you go in there and you try to bet, this one's going to go up, this one's going to go down. And if you do that, you can make a lot of money sometimes, just like the casino. But in the long run, whatever you make, you will lose everything because luck doesn't last forever. In the long run, based on statistics, probability, luck will run out and you lose everything back to the house, which is the market, right? So for me, my principle is I look at the stock market not as a casino where I'm predicting or betting where this will go in the short term, right? I see it as a supermarket of companies. Where companies are on sale every day at different prices.
Okay.
So my job is to go to this supermarket and to identify the highest quality products.
Okay.
And then wait for the sale and go in there and buy them when they're on sale.
Okay.
That's it. And I buy the products that would appreciate in value. So I think that's the first principle, right?
Okay.
Yeah.
I think that's a very interesting way to think of it, the stock market as a supermarket.
Yeah, supermarket. Yeah.
And going hunting for discount, like great products on discount.
Great clearance sale. You know.
Okay.
Yeah. Once in a while, there'll always be a sale.
Okay.
Yeah.
How about you? How many principles do you have? Do you have any other principles?
Okay, so basically I tell people that there are 4 main keys to successful investing.
Okay.
Okay, so I use this acronym WWHW.
Okay.
So the first key is what we call you have to know what to buy.
Okay.
Okay. So what you want to buy? There are over 10,000 stocks in the US. There are over 600 in Singapore. You know which one you want to buy, right? You want to buy the fundamentally strongest stocks. So again, what's a stock? A stock is a business. So in other words, you only want to buy great businesses. I'm not interested to buy mediocre businesses. I'm not interested to buy lousy businesses. I only want to buy great businesses. So again, what is a great business, right? Simply put, a great business is one that makes more money over time. Year after year after year, good times, bad times, pandemic, no pandemic, recession, no recession, company keeps on making more money. And these are businesses where many people use their products, and oftentimes we can't live without these products, right? So that's a great business. And less than 1% of businesses in this supermarket are great. Less than 1%. Okay? So the first thing is to find that 1%. Okay? Second key is once you know what to buy, you must know when to buy.
Right.
So that's where we talk about the discount, right? So it's similar to real estate. Okay, so let's say you find a beautiful apartment, great view, great location, okay? And the bank valuation is 1.5 million. Okay? But then the seller wants to sell at 2 million. Okay? And you buy at 2 million. So it's a great property, but you paid over the valuation. It's a bad investment.
Right.
So same thing with stocks, right? So a great business can be a bad investment if you overpay for the shares, if you pay more than what it's worth, when you pay above valuation. Okay? But a great business becomes a great investment when you can buy less than what it's worth.
Okay.
Same thing with property. So if for some reason that property that's valued at 1.5 million, the seller is desperate for whatever reason, he has to get rid of it, and you can grab it at 1 million. It's a very good investment, right?
Correct.
But we know in property you can find, right? But it doesn't happen as often as stock market, which happens very often. Because stock market is one where there's a lot of liquidity, there's a lot of news and emotions and manipulation that causes a business to sell 10, 20, 50% discount quite often.
Right.
So that's the second key. Buy when it's undervalued. Okay. And the third key is to know how much to buy.
Okay.
How many shares to buy. So I always say that even if you find a great business, please don't put all your money in that one business, in that one stock, because anything can happen that you can't always foresee. Like let's say you bought Boeing before the pandemic. You cannot predict the pandemic. All the planes are grounded, they cancel the Boeing deliveries, and then the Boeing had a plane crash, the design. Then Boeing share price dropped 80%. So if you put all your money in Boeing, it dropped 80%, your whole wealth down 80%, you would cry, right? So always diversify.
Okay.
Always make sure, no matter how much capital you have, whether you've got $500 or $5,000 or $500,000, always divide into minimum at least 8 to 10 great companies.
Why 8 to 10?
At least.
Okay.
Can be more.
Okay.
At least to have enough diversification, so that if one or two in the short term drop because of whatever reason, pandemic, whatever, at least you got the other 8 that can make up for it.
You won't get a heart attack.
So it's kind of like, I say that, imagine you're on a plane. You're the best pilot in the world, but your plane only has one engine. But it's a Rolls-Royce engine. Very good engine, right? But what if you got lightning strike?
Right.
What if you got bird strike? Then your plane will crash, right? You can't predict all these things. But if your plane has got 10 Rolls-Royce engines, what's the chance all 10 Rolls-Royce engines will malfunction? It's almost impossible. I give you 2 engines fail,
Right.
but you still got 8 engines that keep you afloat. All right?
Understand.
Then the fourth key is you must know when to sell.
Okay.
All right, so you cannot sell too early, you cannot sell too late. Some people, once the price goes up 10, 20%, oh, they take profit. All right. If you take profit too early, you will never compound your portfolio into millions and millions, right? You never see the power of compounding, okay? At the same time, if you also sell too late, when something is way overpriced, the business no longer growing and keep holding on to it, then your profits all disappear as well. So you must know exactly when to sell, right? You sell either when it's way above valuation or if the business stops growing or it stops being as great as it was. And there are certain rules that I follow to know when.
Okay.
Just like real estate, you have to know when to sell a particular property, right?
Yep.
Yeah. It's actually the same principle.
Yeah.
Yeah.
Okay, I think that's very interesting as well. When to sell is important because your money keeps going up. There is a time that you need to exit.
You must know when to sell and to reinvest that in a better company.
Okay.
Yeah.
So now it's my turn.
Yeah.
Right. So I'm going to share a bit more about my own personal opinions on real estate investing and what are my principles that I follow too. Okay. So I think the very first thing that I look at would be understanding your plan. Right, because buying a property, I think, is largely an emotional purchase. Right, because you're not just buying something to invest in. Like most of us here in Singapore, we're buying a property for us to stay. So there's that own stay factor as well. But I think one thing that I always like to share with my clients out there is that, okay, understand that this property, will it be a permanent home? Right, this is what I mean by defining your plan. Right, because today, if you're going to buy a property, right, are you going to stay here for 5 years, 10 years, 15 years? Okay, most of the clients when I ask, okay, do you want this property to help you make money? Everyone will answer yes. Right? I mean, who doesn't want that, right? Okay, so by understanding your plan, right, there's certain characteristics that we have to follow through, right? Because different districts, different locations in Singapore, they have different growth potential. For example, like East Coast now, we have the Long Island plan, but it's not going to happen in the next 3 to 5 years. In fact, it's going to take a good like 20 to 30 years for the whole thing to come to life as well. So this is really important to know as well. And I think another concept through understanding your plan is perhaps somewhere you want to stay might not be most ideal for investment. For example, maybe you want to stay in Farrer Road, right? Because it's near to town, near Holland, near Orchard Road, that kind of thing. But it might not be the best place to put your money in, right? Why not buy where it's good to invest, okay? Rent where you want to stay. So this is something that I preach a lot as well. Because today you want to stay in Farrer Road, there's a lot of surplus of new inventory into the market. So renting there, there's opportunity for you to get a good bargain. But whereas if you want to invest, okay, this case study that I did, okay, for one of my clients, I think in 2020, 2021, he had a $2 million budget, single guy. He wanted to buy Farrer Road, all right. So I told him that, hey, why not, okay, we take this $2 million, we invest in Tampines. Okay, so he gave me a very confused face and he asked me, do you know what you're doing? Like, why Tampines? Who will stay in Tampines? That kind of thing. He's quite an affluent guy, family is quite well to do, all right? So, I mean, to him, Farrer Road is a 2-bedroom, it's freehold, eventually it could be a bachelor pad. Okay, so I told him that the potential of Tampines, okay, why is there a better potential? Essentially, he's gonna buy a 5-bedroom there. So, long story short, fast forward to date, all right, that Farrer Road condominium, today he bought at 1.9 million. 1.9 plus lah, okay, which is not bad for a 2-bed, 2-bath freehold, all right, in Prime District, right? Fast forward today, Adam, do you want to make a guess how much it became?
He bought at 1.9.
1.9.
Today?
Yep.
I actually got no idea, but 3?
3. No, it grew up to higher sold, 2.25. Okay. So it made approximately 350k, which
Sorry,
is
I was thinking of stocks. Okay, right.
which is not bad.
Okay,
which is not bad, right?
Yeah.
Not bad. Okay, but do you want to guess how much that Tampines unit made?
Yeah, how much?
Do you want to guess?
No idea.
Okay,
Go ahead.
almost 3 million. Okay, so on average, they are transacting at 2.8 to 2.9. So the same $2 million, I would say, okay, one has made like approximately 800k, the other 300k. So essentially, okay, he cashed out from that property. He went into rent at, okay, the Farrer Road, which is near his family place, right? And he had an excess of 500k profits from there. So I think this is very important. Understanding your plan, right, is very, very crucial in buying a property, especially if you want it to help you make money. I think the second principle that I have as well is buying into something with at least 280 units. Okay, but disclaimer, it also depends on which location. For example, places like Orchard Road, all right, people like exclusive condos, like small number of units, privacy, that kind of thing, right? But general rule of thumb, why I say 280 units is, first up, we need, I think similar to stock market, we need transaction volume, okay? Because if today you buy a condo with like, let's say 50 units, all right, compared to you buy a condo with 500 units, right? Let's say 10% of them will be transacted every year. That 50 units boutique development, all right, there's only 5 transactions in one whole year, meaning that the price will go up 5 times in a single year. But whereas if you have 500 units, it goes up by 50 times.
Yeah, okay.
Okay,
yeah,
so this
volume.
is important. We need volume,
Yeah.
right, to get the price to go up higher and higher. Because if today I'm your neighbor, you sold at $2 million, okay, I want to sell slightly higher. I wouldn't want to sell cheaper.
Yeah.
So this is very important as well. Okay, so next thing that I look for, okay, if let's say you're buying into the new homes market, okay, avoid buying the last plot of land as well, because essentially one example that I'll cite today is Lentor area. Okay, because Lentor right now there's 8 plots of projects that's being transacted, that's being sold, okay, all new homes, right? If you are buying into the last one, the first one they launched at approximately 2,000, 2,001 per square foot. Right, today they are selling at 2002 to 2003. Imagine, okay, now we are at the 4th or 5th plot, I can't remember exactly. Okay, but if let's say today you are the last plot, okay, they will be selling at 2005, 2006. So you're entering at an all-time high. So this is something that we need to be mindful of. Of course, there's also an outlier situation, because perhaps if you're the last one, you're closest to MRT, you're closer to schools. Right, this would be additional bonus, okay, that we would essentially look for as well. And I think the third principle that I want to touch on, okay, is also understanding, plan your cash flow. Right, because a lot of people, they like to buy properties. I mean, it's a huge down payment, probably the biggest purchase one would ever do in their life, right? Okay, so I think planning your cash flow, I have this rule of thumb, at least have 8 months of mortgage savings in your CPF account preferably. Okay, is because that at least, for example, if let's say your monthly mortgage is like $5,000, 8 months that would be 40,000. Okay, hit 40,000 in your CPF. So at least if let's say both husband and wife get retrenched at the same time, your house is safe for at least 8 months. And to me, 8 months, okay, it is still quite ideal for you to go out there, find a job, right? Maybe you get a pay cut, but at least your house is safe, well protected as well. Okay, and it varies as well. For example, I mean, I'm a self-employed person. I don't get a fixed income. So when I bought my property, I have like at least 15 months, okay, of mortgage reserve, right, in my bank account, so that if really, I mean, I break my leg, I cannot do viewings anymore. Okay, my house will still be safe, okay, from all this recession and all. Okay, so these are my principles.
Okay, interesting. Learn something new.
Okay, so well, now I'm teaching you.
Yeah, I know very little about real estate. But so far, everything I've bought real estate, I've made money, but I think it's just luck.
Not luck.
Or just holding.
You made a good purchase, right? I think you made a good
But
purchase.
everything I bought was, when I bought all my properties, it was not to invest actually. It was just to stay.
It's for
But
home.
It's for home, yeah. And they all went up, right? Yeah.
Went up a lot. I mean, right now, for those who are watching, we are actually at Adam's house. He just reconstructed his house as well.
Yeah. I like
Very
to
nice
always
place.
show off what price I bought it at. Yeah. I bought it at 300 per square foot back in 2005.
That is 1.6.
About 1.6 million, yeah.
Yep. And today's, can I share today's?
Yeah.
I think today approximately.
In your opinion, I don't know, right?
Okay, I mean, I did check out the bank valuation of your house as well.
Okay.
Right. So I think today approximately it will be at least a 10 to 11 at least.
Okay.
Yeah, at least over there. So you appreciated a lot, lah. Okay.
Okay, that's not bad. But
Yeah. Okay, so moving on to our second topic for today, I think this is diving deeper into the principles as well. I think earlier on you mentioned about picking the right stock. So what are some factors or characteristics that you look out for when you are picking a company?
yeah. So like I said earlier on, I'm looking at the top 1% of great businesses where I'm confident that in the next 3, 5, 10 years, they will make more and more money over time. And so the business is worth more and more. All right. So how do I know? So there are a few things I look at. Number one is I look at track record, right?
Okay.
So I want to make sure that this business in the last at least 5 years is able to grow their sales, profits, and cash flow consistently for the last 5 years.
Okay.
Because if they can grow their revenue, profits, and cash flow for the last 5 years, that means it's very resilient. It's very consistent and very predictable. That means even in the pandemic, they can make more money. Even in a recession in 2020, they can make more money. And not many companies can do that. In fact, if you just apply this first criteria, it would eliminate 95% of all the stocks in the market or more.
Okay, wow, okay.
Just the first criteria, because I'm very strict, right?
Okay.
Then my second criteria is the most important criteria, which is I only invest in businesses that have little or no competition, that are very monopolistic in nature.
Okay.
Right? So we call that an economic moat, a moat that protects the business.
Okay.
That means they're able to raise prices easily almost every year without losing customers, without losing market share. And the competitors cannot easily take away their business.
Okay.
All right. So, and again, very few companies can do this. Very, very few. Right. But these are companies that have got what we call a very strong brand that people are very loyal to. People are willing to pay more for the brand.
Okay.
Right. Like an Apple, like a Ferrari. Right. And they've got what we call like a monopoly on people's mind share. So when you think of search, you think of Google.
Right.
When you think of fast food, you think of McDonald's. When you think of software, you think of Microsoft, right? So these are what we call brand monopolies, you know. And I always like to ask people this question. I say, if I give you 10,000 today, okay, but the condition is for the rest of your life, you can't use another Google product. You can't use Google Map, you can't use Google Doc, you can't use Gmail, you can't use Google Drive, you can't use YouTube. Will you take the money?
Very hard to live life.
And I can tell you that 9 out of 10 people say, I won't take the money. So that is telling you that this business has a moat. People are not easily able to live without it. Same question, right? If I give you 10,000, would you not use another Microsoft product for the rest of your life? Okay, for me, I can't. You know, and I tell you frankly, even if you offer me, let's say, $500,000 today, cash, but I can't use another Apple product, I won't take it.
Okay.
I won't take it. Because, I mean, using all my Apple products, my iPhone, my Mac and everything, it has allowed me to be so much more productive, making millions, you know. I'd rather not take the $500,000. So that's how I know it's a good business. Okay. But if you have a business that you buy that, people are able to switch to another one. Okay, for example, some people have been asking. Now, I take Grab quite a bit. Okay. But people ask me, would I buy shares of Grab, for example, the stock, right?
Okay.
The answer is no, I won't. Right? Why? Because can I live without it? Yes, I can. And I give you an example.
Okay.
So like, let's say I'm ordering a car and I'm checking the Grab app and suddenly the price surge. It's like, usually, you know, it's $10, now it's $30, right? What do? I'll switch to Gojek.
Okay.
Straight away, I'll switch to Zig and take comfort.
Okay.
Right? So to me, that's not a great business. A great business is one where you cannot switch. It's like, I have to use this.
Okay.
You know? So again, there are many more things. These are two. And then I look at things like company must have very high return on equity, high return on capital, low debt, you know. So I've got altogether 7 criteria.
Okay.
So before I buy a stock, it must pass my 7 criteria. So once it buys, I'm very confident that once I buy, I can sleep well at night.
Okay.
You know, in the short term, if the price goes up and down, I don't care. Long term, I know it's going to go higher.
Okay.
Yeah.
Would you be able to share a bit more about these 7 criteria that you mentioned?
Yeah, so I mentioned a few,
Yeah.
right? So number 1 is the 5-year historic consistency. It must have a strong moat.
Yeah.
It must have high return on equity, high return on capital.
Okay.
Right? Which at least 15%.
Okay.
Company should have low debt, strong
Okay.
balance sheet.
Okay.
So even if interest rates go up like crazy,
It's not affected.
doesn't affect
Right.
them.
Okay.
In fact, many of the companies I buy, they benefit from high interest rates.
How so?
Okay, so for example, I own Apple, I own Microsoft, I own Nvidia, right? So these companies have got so much cash, right?
Okay.
With high interest rates, the interest they earn on their cash
okay.
is more than the interest they pay on their debt, which is very low, right? So high interest rates benefit them. Low interest rates, they also do well.
Okay.
So I like to buy companies that do well in any situation.
Okay.
Okay. In the worst recession, must you still use your Microsoft? You
Yes.
still have to use Microsoft.
Yeah.
In the worst recession, must you still use? You can still use Google, right? Then I mean there are other things I look at which are a bit more technical.
Okay.
But like I look at companies that have got good, they're able to manage their working capital well. So
Okay.
things like their accounts receivables cannot be growing faster than their revenue.
Okay.
Right? Their cash conversion cycle must be falling. Ideally, company must be buying back shares. You know, there's a whole checklist.
Okay. Okay. I think that's interesting. Right. So now it's my turn again. Okay. So you got 7. I got 6.
Oh, 6. Okay.
Okay, I got 6.
Yeah.
Okay, so I think when some factors that I look at in the real estate market, okay, I split it into macro and micro. So 3 macro, 3 micro. So I think the first macro point or factor that I look at would be price point, so your entry price into the property. And essentially I look at 3 key areas. All right, so first up, it will be within the district. All right, so for example, if let's say, we're at District 15, right, East Coast Marine Parade area. If we are at Serangoon, we look at an entire district to understand whether this property you're buying, okay, are we overpaying based on the district price itself? The second thing I look at would be based on the estate, right? So my definition of an estate would be, okay, within 1 km, right, to this property, all the properties within 1 km, right, to this project that you're buying or this house that you're buying. Okay, why do I say that? Because essentially, if you're within the same 1 km, you're sharing the same amenities, right, the same bus stop, the same supermarket, or sometimes the same schools as well. So these are more fair comparison because one district is very wide. For example, on one end of District 15, we have like Mayor Road, right, Amber Road, which is like the supposed more atas areas like in Singapore. But then if we go all the way to the other end, is closer to like Pasir Ris, Tampines, Bedok area, Bayshore area. So the price also is quite different. So that's why I look at the estate as well. Thirdly, I look at the project itself as well. So if let's say you're buying a resale property, are you entering at a spread that is too wide from what the other neighbors are paying for? Okay, so these are the 3 key things in terms of price point that I would look at, okay, before thinking whether it's a good buy or not. Okay, the second thing that I'll look at would be infrastructures. Okay, so this is our URA master plan, right? One thing that I think Singapore government has planned very, very well ahead of time would be this URA, right? Because the master plan essentially is a 5-year plan, all right? What's going to happen in Singapore? Okay, so there's actually this other plan, all right, that looks at a bigger picture called the concept plan. Okay, that the government actually plans 40 years ahead in time. Okay, what's going to happen, right? Whether there will be environmental changes in Singapore. Okay, that's why Long Island is coming up, or on the southern coast of Singapore, the Greater Southern Waterfront. Okay, so all these are actually, it's new to a consumer because we only watch the NDP rally every year. Oh, this is going to happen. But actually, all this, if we dig deeper in the URA website under the concept plan, we can actually see all these plans ahead in time. And recently I went to look at it. Do you know one day, will you believe if one day I tell you that we can drive to Tekong and Pulau Ubin?
I'm not surprised.
Yeah.
In the past, we couldn't drive to Sentosa.
Yeah, okay. So this is already in the concept plan. They already drew it out nicely. Okay, one day we can drive to, like, from Changi to Pulau Ubin.
So I should start buying property in Ubin now.
Start investing in Pulau Ubin. Yeah, first mover advantage.
Can we even buy property in Ubin now?
Actually, I also don't know.
Okay, go ahead and find out.
I go and find out. Okay, maybe you buy the whole Pulau Ubin.
I buy the whole Pulau Ubin.
Okay, so this is infrastructures that we look at, whether there's new MRT lines coming up, malls and all, because these essentially they generate activities, they increase the livability to the consumers, to the homeowners out there as well. So the third factor that we look at would be demand and supply, because likewise every district, their demand and supply performs very, very differently. Right. For example, Singapore essentially is broken into 3 regions, right? The CCR, the RCR, and the OCR. So OCR are generally dominated by a lot of new homes, all right, under the HDB markets. So there's a lot of BTOs. So essentially, if today you buy, if you want to invest into a 3-bedroom, if let's say your price point is okay at 1.5 plus minus, I would say these areas are ideal because in future there will be a lot of demand from all the upgraders. Once they hit MOP, right, essentially it's a 8 to 10 years frame. Because if today, let's say I'm 26 years old, I BTO with my girlfriend, I wait about 3-4 years, right, to get my keys. I need to wait another 5 years, then I can sell. So that is a 8-10 years period. So after waiting for 10 years, okay, I can finally sell my house and buy a private property to upgrade. Yeah. So there's a lot of demand in such areas as well. And the demand and supply situation, for example, at District 15, the East Coast area, is very unique because there's very, very little HDB. So that's why the landed housing and the private condo housing here is very, very resilient, right? Because most of the private condos purchasers, consumers, okay, they are actually downsizing from a landed home. Because if fast forward, let's say 20 years later, right, you will be in your 70s. Right? Yep. Let's say your children all move out, like they get married, they start their own life. Okay, this is a house very, very big for just 2 person. Yeah. Right? So essentially, you might buy a condo in time to come. So, but if I ask you to move to West Coast, East Coast to West Coast, you might not want to.
No.
right? Because you're
Even for 10 million, I won't.
yeah, because you're so familiar, with this location, you're comfortable here already. So that's why you will look around these areas. Another estate that has such characteristics would be like Bukit Timah as well. There's virtually very, very low supply of HDBs in that area. That's why the condo markets there, I would say they are pretty much on their own, not dependent on the rest of Singapore. Yeah.
Okay. Cool.
Okay. And now for the next 3 factors on macro factors. So next is also in terms of occupancy type. Because today if I were to buy a property, okay, next time who am I going to sell to? I would want to sell to a family compared to an investor. Because investors is all about dollars and cents, they're more sensitive on price. Okay, but if this is highly occupied by tenants, so this is something that I might not want to buy into. But of course, it also depends on your strategy. Because if you're buying for rental yield, then yes, of course, we go for that property. But if you're going for capital gain, then I would want to find a project that's less tenants, more owner-occupiers that are buying there for their own stay. Okay. The fifth factor that I will look at, okay, is a competition comparison. So understanding your location, what are all the competitors in terms of their layouts, their price point. Okay, so we compare with that to understand, okay, whether you're buying to the best layout. Because layout is very important because you are buying a house, okay, for your own use. If you buy a round house or a triangle house, it's a bit awkward. Most people might not accept that. They will not be receptive to that. So we have to compare with all the competition over there as well. And the last point that I like to coin, okay, it's a term that I came up with. It's called buyer's desirability. Okay. So there's 4 factors I look at as well. So first up is about the condition of the house. So your layout, the view of the house, okay, the upkeep of the facilities, the condo maintenance and all. So these are important. Second thing would be connectivity. So like what are the amenities you're connected to? Are you near to a bus stop, a MRT, a supermarket, so on and so forth? So being well connected, you increase the desirability of someone buying into your property. The third factor is actually under connectivity as well. But Singapore, we have this 1 km effect. All right, so primary school, right? So if you're near to Ai Tong or Nanhua, okay, or Nanqiao, right? All these schools, they are more preferred by parents out there, that they don't mind buying a property just to be close to that 1 km to move for the school as well, which I see very, very often in the market today. Okay, and the last point, okay, would be value of the property. Not just the present value, but also the future value. What's coming up in the area, tying down with the macro factors like the infrastructures, the master plan, what's coming up. So these are the 6 key factors that I look at when it comes to investing into a property as well. Okay, moving on to our third topic for today, Adam. Right, can you share with us what should the mindset of an investor be like?
Okay, so actually in my course, I actually teach 10 psychological traits you need to have. And what is important is, I always tell people that to achieve success in anything, whether is it career or health or business, 70% comes from psychology, your mindset. And only 30% is the how, is the mechanics, right? So when it comes to investing, certain psychological traits. Number 1, I think the first thing is discipline. All right, you need to have a lot of discipline, and discipline means you only buy and sell based on predetermined objective rules that are in your investment plan. Okay. So again, before I buy a stock, it must meet my 7 steps, my 7 criteria, right, which I mentioned just now, right? Only when it meets all the steps, it's a great business, it is undervalued, it's retraced a support level, then I buy. All right. And same thing, there are predefined exit rules. When this happened, then I sell. Okay. So easy to say. But I can tell you that most people who invest, they got no rules. They got no rules, right? They buy based on emotions. People get excited about stock, they get excited, they buy, right? Or they buy based on some news. The news say, oh, recession, oh, sell, right? Or the news says that the Fed gonna cut interest rates, then they buy, right? Or they are affected by the opinions of people. Like this Warren Buffett, sell Apple, oh, I sell Apple. Or this Jamie Dimon said a crash is coming, you know. So they keep doing that. And if you do that, you'll never make money. Right? In the end, you're going to lose all your money. Right? So you got to invest based on a set of rules. All right? So I've got my rules, and you should develop your own rules. Or if you want, you can come and learn my rules. Right? Another important trait is to be an investor, you must be able to think very independently. Right? The trouble with most people is, as human beings, we tend to be creatures of conformity.
Okay.
We tend to be comfortable with the crowd. Most people are like that, right?
Yeah.
When everyone gets excited, we get excited. When people get scared, we get scared.
Okay.
And if you're like that, you definitely lose money in the stock market.
Okay.
Or even the property market for that matter, right? Because when everyone is excited about stock, what does it mean? That means the price is high. That means it's selling at a premium. And if you buy when you are excited, when everyone's excited, you're always buying high. Okay? Then when is everyone scared? Everyone is scared when the price drops. Everyone's scared when there's bad news. And if you get scared and you sell, you always sell low. That's why most people always buy high, sell low, buy high, sell low. Right? So the only way to make money is you have to train yourself to go opposite of everyone else.
Okay.
So like what Warren Buffett said many years ago, be greedy when everyone is fearful. Be fearful when everyone is greedy. Easy to say, hard to do. Right? Because it's human emotions to be with the crowd, right? So one of the things that I would say is one of my advantages is since I was young, I'm a very rebellious person.
Okay.
I'm the person that likes to go opposite of the crowd. When everyone is running left, I like to run right. It's my personality, okay? So that has helped me a lot as an investor. But I tell people that if you're not like that, if you're someone that likes to follow people, nothing wrong, but you have to train yourself to go against your comfort zone, okay? But of course, there's a disclaimer. When we say be greedy when people are fearful, buy when everyone is scared. You must buy the right thing.
Yep.
Right? You buy the wrong stupid company and lose money, it will drop and never come back. So you, again, only buy the top 1%. You buy only the best companies when everyone is scared of whatever, war coming, recession. Everyone's scared. The only time a great business is at a discount is when there's bad news. Same thing with property, right? The only time a great property is at a discount is when there's some bad news. The owner die or the seller bankrupt, for sale auction. That's the only time you can get a good price. So sad to say, there must be always some kind of misfortune for you to get a good deal. Most of the time, right? To get a really good deal, right?
Okay. I think that's pretty interesting. I think one of my points actually overlap with what you share as well. Because I mean, there's a lot of new launches in Singapore. So a lot of people, they like to, this project, there's like 10,000 people visiting the show flat. So people, they will have a FOMO effect. Right? They fear of missing out. Or if I buy, everyone buy, I buy, shouldn't be wrong.
Yeah, the sheep, right? It's the lemming, right?
They just follow that. So I have this, I actually monitor the market. I did my research as well. I think it's quite interesting because certain projects in the past 5 years, I would say, it's actually popular projects. A lot of people are buying, but they are not the biggest earners. Like, for example, the example that I cited you just now, the one at Farrer Road, right? So that actually didn't make the most money. Whereas the other one, the Tampines one, it took a longer time to sell. So that actually made more money as well. So I think this is really one psychology that I think for a real estate investor, they should be mindful of as well. Because it's not that everyone buy means it's a good buy. Because you don't know what's the intention, right? What's the plan of other people buying? Maybe people, they just want to stay at that area because families are there or they want a certain school. But if you're a single person, okay, you're not staying there for any schools or anything, then it might not make sense for you to put into that. So I think for me, the mindset is really being clear, okay, of your objective and your plan of this investment. Okay, what is it for? Is it more for own stay, for the location or not? If not, like, why not explore renting and put your money somewhere else that is better to invest in as well? I think most importantly, I just want to add on as well for the psychology of a real estate investor is really to understand the district and the type of product that you're buying into. Because I still hear a lot of people say that, we should always buy freehold. Okay, we should never buy 99 years because one day you don't own the property, it goes back to the government or the developer, that kind of thing, which is highly untrue as well. Because I think from year 2000 and before, right, most of the properties that are actually sold would be freehold properties. From year 2000 onwards, majority are actually 99 years leasehold property. And if we look at today's market landscape, I would say that most of the near to MRT condos, okay, they are actually 99 years, right? And those further away boutique developments, okay, they are actually freehold. So this is something that I think a lot of people out there are blindsided, that they always think that, freehold is better. Because sometimes we see, like, let's say a 99 and a freehold in the same district. The freehold might be at the same price or slightly more expensive, like probably a 5-10% more expensive than the 99 years. Then people will think that, freehold is only 10% more. It's a better buy. Let's go for freehold instead. But there's other attributes like what I mentioned, the 6 factors earlier on, that we have to assess thoroughly, okay, to really explore these factors in depth, to really understand the product, understand the district that you're buying into as well. Okay, so these are what I have for psychology of an investor. Okay, so for the fourth topic of today, all right, so Adam, would you share with the audience like what should a first-time or a new retail investor take note of when they're starting investing?
All right. So, when a lot of people, they come up to me and even family members, they say, what should I invest in, right? And the first question I always ask them is, are you passionate about analyzing businesses? Right? And if you're not, it's fine, okay? And I would say that 90% are not. 90% of people are not interested in business. They are not interested to study businesses and revenue and profits and all that. And I say that if you are like that, you're the 90%, don't buy stocks, right? Don't buy stocks. Just buy an ETF.
Okay.
So an ETF is a basket of stocks.
Yep.
And the most popular one is the S&P 500. So when you buy the S&P 500, you're buying the 500 biggest companies in the US. That's it. Just do that, right? And every year, just put in a bit of money, dollar cost average. If you do that in the long run, you're growing your investments roughly about 10 to 12% a year, right? Which I think beats. And if you do that, I can tell you that you will outperform 90% of investors out there,
Okay.
right? However, if you're the 10% of people who say, I want to get better than the market, I want to get more than 10 to 12% a year, I want to get 15, 20, 30% a year, yes, you can, but you have to put in the work. You must be willing to learn how to analyze businesses, right? And I tell people that everything in life is risky if you don't know what you're doing. It's like, swimming is risky if you have never taken swimming lessons. If you don't know how to drive, drive is risky, right? So if you try to invest in a market, buy stocks yourself, if you don't know how to invest, how to analyze businesses, how to value businesses, it is very risky. Chances are you're gonna lose everything, okay? So if you say that, I want to buy stocks, you have to learn. You have to take swimming lessons, you have to take driving lessons, you have to take investing lessons. And I always tell people, you don't have to learn from me, you can learn from whoever you want. Okay? But whoever you learn from, make sure that they have a proven track record they can show you. That they themselves have a lot invested in the markets and they can show you at least the last 3, 4, 5 years how they've performed, right?
Actually, I think this is something that I just want to touch on as well, because I think there's a lot of people out there that teach us, right, about value investing, options trading and all, but not many would be as open or transparent as you to show your account, right? Because I think the last I saw your account is 18 million?
Okay, US stocks is about 8.4 million US.
Okay.
My Singapore stocks is about 4.3.
Okay.
And the rest, I think another 4-5 millions in bonds.
So that's about 18.
It's about there, yeah.
Okay. What are you gonna do with all that money?
I just grow it, right? To me, it's a game.
Right.
One of the things I realized is that once you have made a certain amount, anything more than that, it doesn't change your lifestyle.
Yep.
You still eat 3 meals a day.
Yep.
You still buy toilet paper.
Yep.
Right? And in fact, I tell you the strange thing, because I've got close friends who are extremely wealthy, worth hundreds and hundreds of millions. And what I realized is that many of them, the richer they get, the more simple they get.
Okay.
I've got a very close friend, I won't mention his name. He's worth, I don't know, at least $300 to $400 million, and he's come to an age where he doesn't even have a credit card anymore. He said, I don't want to simplify my life. He sold all his country clubs. He drives a very small, those mini car, right? In fact, most of the time he doesn't drive. He takes Grab, like me. He, what's the other thing? Yeah, he only has a debit card.
Okay.
And he's a very simple guy, right? But of course, everyone has their one luxury that they'll spend on. We all have, right?
Yep.
So for this guy, it's wine.
Oh, okay.
Right. So he would spend in a year, and I'm not exaggerating here. He'll spend 300,000 to 400,000 on wine a year. But he'll give out to his friends as well.
Okay.
Okay. But that's his luxury. Okay. And we all have our weird luxury.
Okay.
Some people it's car, some is wine. Everyone has got their own weird thing.
What's yours?
That's a good question. The interesting thing about me is that I don't have an expensive hobby.
Okay.
When I was young, I used to love fast cars and all that. But now at this age, it's like I have no interest in fancy cars and all that.
Yep.
I have no interest in cars. I've got no interest in fashion. I've got no interest in watches. I've got no interest in drinking. I don't have any expensive thing. The thing that gets me excited is actually spending time with family.
Okay.
Which is the best thing is it's free. well, it's not really free. You still have to go out and spend money with your family. But it's a lot of the intangible things that make me happy, which is not something you buy. Yeah.
I think this is really something that I feel that I could testify a little, because I mean, 18 years ago, you are 32. 32, right?
I'm really bad at mental math. Okay, what's 50 minus 18?
32.
32. Okay,
32.
yeah.
The number's too small, you cannot.
I've never been good at mental math. I always need a calculator. Yeah.
So I think I was a 16-year-old boy, okay, looking at you over there, 32-year-old, right? I mean, you were driving a convertible, a BMW, I think it's a 3 Series back then.
Yeah.
Then subsequently you changed to a Lotus. So I think that was like a total phase that I think you have outlived. That is really no longer about the material stuff. It's more all about the tiny little things that makes it more meaningful today. And I think, correct me if I'm wrong, I think you putting so much time and effort into starting the stocks and company is also about the feeling of winning, right? Beating the stock market.
It's a game.
It's a game to
really
you,
a
right?
Game now. Yeah. It's a game. Yeah.
Okay, that's interesting. Okay, so for myself, I think for a first-time homeowner, what should you guys be looking out for is really planning ahead of time, right? Because a lot of people, they buy a house, okay, so how long are you going to stay here? What is this house going to do for you? They don't have these answers in mind. So how I usually work with my clients is also I'll explore more in depth with them to understand their plan moving forward, whether they do have aspiration to want to, let's say, move to a landed property in time to come. Because what they buy today essentially is a stepping stone for them to get there. Because if today you're moving from a HDB to a HDB, it not say that you cannot get there. I mean, if let's say you're doing business, your income is doing well, you can get there eventually as well. But property is something that I see can really help people fast forward, right? Like myself as well. I mean, I have never imagined myself owning 2 properties before age 35, and I'm very happy to do that. And I think it's through putting money into the stock market as well, through growing wealth. And I'm already planning for, in 2026, when I pass my seller stamp duty period, right, in 26, I'm going to sell both properties and make my next big purchase. All right, so essentially this money that I've put into the house, all right, they're going to come back to me eventually when I cash out, which I think is quite similar to when should you sell. Because a lot of first-time homeowners, they always get this is my first home, my matrimonial home. I don't want to sell it, it's so comfortable, the location is so good. There's a huge emotional attachment. My firstborn was born here. So they are reluctant to sell for these reasons, and they don't want to pay the ABSD to buy their second. So they're kind of in a stuck position because they weren't clear of what this house is going to be for them in time to come. So I think this is really something for first-time homeowners they should be very mindful of. And also another factor that I point out on the principles as well, which is essentially planning your finances very, very well. Because a lot of people, not a lot of people, a small handful of people, they actually squeeze their bank accounts dry to buy a house.
They overstretch, right?
They overstretch. Okay, so this is something that I would not advise to. Okay, because we really need to be mindful. I mean, COVID really hit the events industry, for example. I used to be from the events industry as well. So it really hit that market very, very badly. So things might happen, finances might change. So these are some of the key pointers that I would say a first-time homeowner should be mindful of as well. Okay, so these are our 4 key topics that we're going to talk about today. But before we call it a day, before we close it, all right, Adam, can you just share with us some of the stocks that you are bullish on? Can you give us some insider tips?
In the long run, the market always goes up. Okay, and high quality companies will always go up. Okay. In the medium term, I've said this many times in my videos, and especially last year during an event, which is what I call the 6th wave.
Okay.
So if you look at the markets and the economy, in the long run, they are divided into what we call waves of innovation. Okay. So for example, the last wave was the 5th wave. The 5th wave was 1990 to 2020. It's 30 years. The 5th wave. Each wave is about 30 years, right? And during each of these waves, it's a series of innovations that change our life, that transform businesses, that create new businesses and create a lot of wealth, right? So for example, in the 5th wave, what was invented? Software. Software was invented, MS-DOS, right? Then Windows and all that, right? And then the internet was invented. And then social media was invented. And then cloud computing. And then the mobile phone, right? So the question is, did all this change your life? Has software changed your life?
Yes.
Without software, your life would be very different, right? Has the internet changed your life? Has social media changed your life?
Yeah.
All this changed your life. And all this has created new businesses like Netflix or Meta or Facebook, WhatsApp. And it has transformed businesses like Apple and all that, right? And in the fifth wave, the stock market in 30 years, the annual return is about 10.5%.
Okay.
Through the ups and downs and ups and downs and ups and downs, right? And I mean, I made my fortune in the fifth wave. And I know a lot of people did as well. And I tell people that if you did not make your fortune in the fifth wave because maybe you were too young or you didn't know how to invest, the good news is we're now in the sixth wave.
Okay.
And the sixth wave started in 2020.
Okay.
So we are now only the fourth year of the sixth wave. And the sixth wave will be the most powerful wave.
Okay.
It will be the most revolutionary because the sixth wave is the AI revolution that is transforming every single business, that's transforming our lifestyle. AI and robotics.
Okay.
Okay? So a lot of the stocks I'm invested in are riding on this long-term AI revolution.
Okay.
Okay, so whether is it certain software companies like Adobe or Palantir or Microsoft, or hardware companies like Nvidia or ASML, that is one area, right? And the other area is healthcare. So we know around the world people are living longer, they're growing older, they're spending more on healthcare. So I invest a lot in healthcare companies. But the funny thing is I don't buy pharmaceuticals, drug companies, because they tend to be more unpredictable and the patents don't last forever. You always need new drugs to come in, right? So I tend to like to invest in what we call medical equipment and medical devices and medical instruments, as well as like hospitals and stuff like that. It's more predictable, it's more consistent, the growth of the revenue.
Okay. Wow, so that's I think that's very insightful as well. Because of you, I mean, I bought a lot of SMCI previously. When it went up, then it started to come down, I sold all as well.
You're lucky.
Yeah. So
I didn't buy that one though.
Oh, but you mentioned about SMCI.
But I never bought it.
Oh, okay.
Yeah.
Okay, but I took the plunge.
Okay.
Yeah, so I did make quite a sizable amount.
Lucky you sold before it went down, right?
Yeah. Okay, so thank you guys for watching our video. If let's say you have anything you want to find out from the real estate market or from the stock market, you can follow Adam on his channel. We'll put down the link in the description below. Great, my name is TJ and we have Adam here with us. So we'll see you soon.